What if I told you this entire price move was predictable? Not because of news, not because of indicators, but because of one hidden pressure zone that most traders completely ignore. Hello, traders. Welcome to the very first episode of Smart Trading Tools, a series where we don't chase the noise, but instead decode the invisible mechanics that actually move crypto markets. Today, we're diving into one of the most underrated tools used by smart money, liquidation maps. This is not about guessing tops or bottoms. This is about understanding where the market is structurally fragile and how price often hunts those weaknesses. In crypto, especially in markets like Bitcoin or Solana, where leverage is everywhere, price movements are rarely random. If thousands of traders are using 20x, 50x, or even 100x leverage, you can be sure of one thing. The market knows where they will be liquidated. And when the market knows, it hunts. These liquidation clusters become pressure points. They form zones of inevitable pain, places where over-leveraged traders will be forced to exit, whether they want to or not. This is the part most retail traders never see, but professional traders study it closely. There are tools like CoinGlass and Hyblock Capital that visualize these pressure zones on a chart. What you get looks like a heat map, red zones above or below price, showing where forced liquidations will occur if the market pushes that far. And here's where it gets interesting. When a lot of traders are long, meaning they're betting on price going up, their liquidation zones sit below the current market. That creates an opportunity for aggressive short sellers. If they can push price down into that zone, a cascade of forced selling will amplify the move. On the flip side, if the majority of market is short, then the liquidation zone sits above. A sudden move upward can trigger short covering, where bears are forced to buy back at higher prices, adding more fuel to the rally. This isn't a conspiracy theory, it's structural behavior in a leveraged market. And liquidation maps are one of the few tools that can make this hidden dynamic visible. So how does it actually look? Let's simplify it. Picture a heat map with current price in the middle. Red bars above show the levels where short positions will be liquidated if the price rises. Green bars below highlight the zones where long positions will be forced out if price drops. But just knowing these levels isn't enough. The key is in how price interacts with them. Let's walk through 3 real-world patterns that traders watch when reading liquidation maps. First, the classic stop hunt and reversal. Price inches up toward a red zone, a cluster of short liquidations. As it hits that zone, a burst of activity occurs. Shorts are forced to close, volatility spikes, and then price reverses. It's as if the market went up, took what it needed, and turned around. This is what people often refer to as a liquidity sweep or stop raid. Second, the clean continuation. In this case, price doesn't hesitate. It pushes through the liquidation zone with strength. No trap, no reversal, just clean follow-through. This usually happens when overall sentiment and funding are aligned. There's no resistance to the move, and the market simply walks through it. Third, the compression trap. Sometimes price slowly grinds into a liquidation cluster, not with strength, but with weakness. That's a danger zone. When the market compresses like this, it builds up tension. When the release comes, it's violent, but in the opposite direction. Traders betting on the breakout get wiped out by a reversal they didn't expect. This is why maps are not signals. They are context. And professional traders know how to use context to their advantage. They don't rely on one tool. They stack signals. A good trader looks at a liquidation map, then checks open interest. Is it rising or dropping? They check funding. Who's paying? Are traders aggressively long, or is the crowd fading the move? Volume profile adds another layer. If absorption appears in a liquidation zone, meaning someone is stepping in to buy or sell against the crowd, that could confirm the setup. When all 3 align, map, OI, and funding, you don't just have a guess, you have probability. And that's what trading really is, managing probability. But it's easy to misuse these tools. Many new traders see a liquidation cluster and assume it guarantees a reversal. That's a trap in itself. Liquidation zones can act as magnets, but they can also act as fuel for continuation. Context matters. Another mistake? Ignoring trend. If you're looking at a liquidation map without considering the broader structure, like whether price is breaking out or consolidating, you're working with a partial picture. And finally, using liquidation data in isolation. This tool is powerful, but only when framed within a bigger structure. Example, Bitcoin's liquidation cascade, April 12th, 2024. BTC had been ranging tightly between 65,000 to 66.5 thousand, with open interest climbing and funding staying neutral positive. A large cluster of long liquidations was visible just below $65,000, as shown on CoinGlass and Hyblock heat maps. What happened? A sharp sell-off pushed BTC just below $65,000. This triggered a liquidation cascade, wiping out over $150 million in long positions in under 30 minutes. Price dropped fast to 62.8K, then sharply rebounded. Why it matters? This is a textbook compression trap. Retail traders went long during the range. Liquidation maps showed where they'd be vulnerable. Price dipped just enough to force sell-offs, then reversed. What pros saw? Increasing open interest, over-leveraging. Funding flipping bullish. Heat map showed liquidation cluster building below price. Traders who read this context weren't surprised. They were positioned to fade the breakdown or buy the forced flush. So what's the takeaway? In this episode of Smart Trading Tools, we didn't predict the market. We learned how to read what the market is structurally incentivized to do. Liquidation maps don't show the future, but they show us where tension lives, where the crowd is exposed. And that's the kind of information smart traders watch, while others look away. In the next episode, we'll break down another insider tool, CVD, or Cumulative Volume Delta, and how it shows whether big players are buying into weakness or quietly selling into strength. Subscribe if you're serious about decoding the real signals in crypto. If you see any comments promoting random coins or promising huge returns, ignore them. We never endorse projects in the comments. Stay smart, stay safe, and always do your own research.